Hello and welcome to Startup Street. I'm Arundathi and with me is Ritu Singh. These are the top headlines from the startup space. Legacy blue ticks disappear as Twitter begins its much talked about purge. Elon Musk puts out a cryptic tweet saying such a great day in so many ways as several celebrities, politicians, athletes lose their verification status.
Health tech startup Crore raises $8.5 million in Series B funding round from Omron Healthcare and Japan's Sony Innovation Fund. The funding will be used to expand the product line for remote patent monitoring and to scale business across Asia and Africa.
Actor Akshay Kumar and former cricketer Virendra Sehwag have invested an undisclosed amount in farming startup Two Brothers Organic Farms. They have invested a total of 14.5 crore rupees as part of a pre-Series A funding round.
Meta CEO Mark Zuckerberg announces a new feature on WhatsApp which will allow people in a chat having disappearing messages to save them when they need the most. Called a sender superpower, the feature Keep in Chat will allow users to retain important messages even if disappearing messages is enabled.
Italy's antitrust authority has taken measures against Meta over an alleged abuse of its position in the country. In a probe involving the rights to music posted on the group's platforms, last month Meta failed to reach a deal with the Italian Society of Authors and Publishers, SIAE, to renew copyright licenses. Those were the headlines that we're tracking for you this evening. Now, House of Brands startup Curefoods bagged 300 crore rupees recently in a mix of equity and debt. The round was led by Binny Bansal's fund, with other firms like Iron Pillar, Chirate Ventures and Ask Finance also participating. Now, the startup plans to use the funds to expand geographically and diversify into the offline space. Joining me now to discuss the company's growth plan is Ankit Nagori, the founder of Curefoods. Ankit, thank you so much for joining us on the show today. Like I said, you're a house of brands. Let's talk about the growth that you're seeing. Talk to us about your best performing brands. Which are the other brands that you expect to pick up this year? Where will the focus be?
Right. So, Arundathi, I think we've been fortunate enough to have momentum in multiple brands. It's very hard to get this kind of momentum in more than 3-4 brands. But if I have to talk about my house of brands, we've built EatFit, which is our anchor brand, and it's scaled up to over 12 cities, 100 plus kitchens, doing pretty well. The second largest brand for us is a brand called Cake Zone. It's a bakery brand. We sell thousands of cakes every day online, and people are able to order cakes across about 25 cities. The two new brands, though, which are really our focus areas this year, are brands called Sharif Bhai Biryani and Nomad Pizza. Sharif Bhai Biryani is one of the leading biryani brands in the country. It's largely in South India in 3 cities, and across 22 outlets, we are doing a very, very good business. And the aim is to now take it to 50 outlets in the next 12 months. Majority of them would be offline stores. So now we have started opening physical outlets for the biryani brand, and we're seeing very good response. We recently opened in Chennai, Mysuru, Hosur, outside of Bangalore. And the last brand is a pizza brand called Nomad Pizza. It's our luxury pizza brand. It's a 1,200 rupees AOV, and it's present in the top 4 cities in the country, which is Bangalore, Bombay, Delhi, Pune right now. And the aim is to keep expanding the cloud footprint, but also open some really large pizzerias where customers can come and dine in.
Right. You've raised 300 crore rupees in equity and debt. How much of it was equity and how much debt? How are you going to use these funds?
About 90% of that was equity and 10% was debt. And the aim for raising this smaller round this year was because we're about to turn profitable, so we don't need a lot of money. But we raised this round to be able to experiment with the offline footprint. Our online food business is pretty established, Arundathi. Now, we have a quarter-on-quarter growth. Business is very close to profitability. If we didn't do the offline, we'll still continue growing and we will be a good online first business. But the size of the prize is much bigger here. We clearly see an opportunity to build a pretty large F&B play. And we are pretty cognizant of the fact that not everyone wants to order online for all occasions. There are enough and more occasions where customers will order, will go out as a group to offline. There will be many occasions where they would want to dine out. We don't want to be missing from those pieces in their lives. And hence we are beginning to do offline. And I'm calling it an experiment right now because we don't have enough traction while Sharif Bhai stores are doing well initially. So we've created some war chest for these experiments.
So you've created a war chest for your offline experiments. Now you claim to have seen 300% growth in the last financial year. Where is this growth coming from? Give us a sense of the current revenues and how far is profitability?
Right now, Arundathi, we are at a 700 crore revenue run rate, and close to 700 crore revenue run rate, or maybe I'll say that we will be at 700 crore revenue run rate this year. We are tracking well to that, and the profitability is actually stemming from the fact that we had opened a lot of cloud kitchens in the last 12 months, and now they're all reaching an optimum efficiency and usage space where we are doing a lot of throughput from these stores, and we have a pretty high usage. And the metric there is number of orders per day per kitchen, and we are seeing a very good throughput. The idea has been, to keep growing in the multi-brand kitchens. And why multi-brand? Because then you can order across different slots through the day, different kinds of meals through the week. Because if you're just one or two brands, you'll not get enough utilization through the day. Because if you're a pizza brand, it's a weekend brand. If you're a salad brand, you're a weekday brand. So which is why we have a mix of brands. So our profitability stems from the fact, Arundathi, that we are multi-brand, multi-category, multi-price point, and we have very high utilization of kitchens. So that's where the profitability is stemming from. By end of this year, we'll be at 1,000 crore revenue run rate, and that would mean that we'll be well beyond profitability. We'll be closer to a 5% EBITDA, and it will still be far off from where the listed food companies are. They're at 12, 15, 20% EBITDA. So that's where our journey begins, to the 12%, 15% mark, and offline will have to play a big role there.
So profitability by this year end, and offline will have to play a big part. You currently have a digital first approach and you want to diversify, like you said, into the offline format. So take me through what the strategy is for your offline plan.
So we are going to open single brand stores where there'll be a Sharif Bhai store, there'll be a Nomad Pizzeria, there'll be Eat Fit cafes and HRX salad bars. So we're trying to create single experience because we believe that it's a very vertical-led experience. If you're going for a salad, then you want a certain kind of ambience and certain kind of sides and appetizers, etc. So that's the approach. Our biggest bet right now will continue to be Sharif Bhai because they've seen some success there. We've seen some success in Sharif Bhai offline stores, so want to double down on that. But I really believe in the medium term, Sharif Bhai, Eat Fit offline, Nomad Pizzeria, all these three will be equal size opportunities, and also some of our long tail brands such as HRX, Rolls on Wheels, and Frozen Bottle, which already have some offline presence, will continue to grow.
Right, and what's the mix that you hope to see going forward between the online and the offline space?
By 2024 end, which is 18 months from now, we hope that about 25% revenue should be offline and 75% be online. Long term, it has to be 60-40.
All right, Ankit, thank you so much for joining us on the show, and we wish you all the best going forward.
Well, moving on, Chennai-based Agritech startup WayCool has decided to consolidate its 3 FMCG brands under a separate company. Now, earlier today, the company launched its new wholly owned subsidiary, Brands Next, that will begin operations under a new CEO and with 108 SKUs. CNBC-TV18's Jude Saneth caught up with WayCool's MD Karthik Jayaraman and Brands Next CEO BP Ravindran to get the lowdown on what the demerger means for the business. Here's a slice of that conversation.
We are into 3 brands, as you said, and we are into rice, we are into dals, we are into spices, we are into sweeteners. So we are into nuts, dry fruits. So there is a larger portfolio which cuts across the staples platform under the brand name of Madhuram and Kichinji, and now we've recently launched the specialty rice of biryani rice, which is the Kichinji biryani rice. And in the dairy platform, we have milk and curd under the brand of Freshies, and then we have a portfolio under the value-added dairy, which is cutting across paneer, cutting across breads, batter. So if I have to put all this together and see what is the total number of SKUs which would be hitting into the market, is around 108 SKUs actively would be hitting the market across in the southern part of the geography.
And new categories that you're getting into, and how many SKUs are you targeting going forward?
Okay, so new categories, largely we are working on categories which have adjacencies to what we are doing, and that's how we'll be able to synergize what we are doing. So the meal solutions category is one category, which we are looking. Meal solutions largely would address the convenience need of the consumer, right? And then we're looking at the value-added dairy category as a big piece, which also has a lot more headroom to offer, right? Both in terms of revenue as well as margins, right? The third piece is, of course, In the rice, while we are there, the everyday rice, our recent launch of biryani rice is one way of announcing that we will be entering the premium ranges of specialty rice and specialty dals. So that would help us both aspects of top line and bottom line.
And when you say mid solutions, what products exactly are you referring to, Mr.
We're talking about, when I say meal solutions, it's largely about breads, batter. So these are what we call as alternate meal solutions.
All right. And moving forward itself, it is a fully owned subsidiary of WayCool. So I'm guessing that any fundraise, any ownership structure will of course be relatable to what WayCool presently has and will be in the future as well.
That's correct. WayCool is the sole financier and investor into this company, and the company will be a subsidiary of WayCool.
And in terms of revenues itself, how much of WayCool's revenues do the three brands that are now part of Brands Next occupy, and where will growth and revenue share really be derived as far as this new venture is concerned in the near to medium term?
So 25% of our revenues come from these three brands, and the brands are expected to double their revenue going forward in the next year. And I think there is a consistent growth path mapped out for these brands going forward.
Right. And so when you say 25%, could you give us some insight in terms of what the revenue was for FY23 and what's the outlook really for the next year?
So the revenues for these brands were approximately 400 crores, and they will double next year.
Okay. And for WayCool itself, sir, what was the revenue like?
We hit our plans largely, about 1,800 crores of approximately of revenue and 2,000 crores of merchandise value. We do some products where it doesn't pass through our books. So that was our plan, and that's what we hit.
Right.
And we'll continue to maintain a growth path as we go forward.
Okay, so when you continue to maintain growth path, I know for a fact that we're in a time and place where, the startup ecosystem is in a challenge of sorts. Capital markets haven't exactly been the most supportive. So what exactly is your growth outlook going forward? I know that you're confident of maintaining, but is growth expected this year, and if yes, by how much?
See, the focus is on accelerating the path to profitability because we want to be independent. And if whichever part of our growth supports this, we will continue to support that growth. That's the way we are looking at it. So if I were to, I don't want to pick a number at this stage, but any growth that is additive to or accretive to profitability will be supported.
Right. Mr. Ravindran, I have to ask you, in terms of, Brands Next itself, what exactly is your distribution network going to be like? Because in the FMCG space, the fact is you are going up against some very well-known names, all market leaders in their own right, the likes of a Tata Consumer, an ITC or a HUL. So in terms of distribution, what exactly is the strategy to ensure that you match up and also compete with some of the giants that exist in this space at this time and place?
I think the key for our success lies in the distribution and our ability to reach as many households, as many consumers at the arm's length. So we are at 60,000 outlets as we keep talking to you now, and we intend to exit FY24 with 1.6 lakh outlets. Right. That's the kind of leap which we intend to take. And in terms of reach, if I have to take it furthermore, up to 30,000 population towns in the southern part of the country, these 4 states, we intend to be present there. Now that means it's a strong distributor network which would have to fall in place to get this happening. So looking around 700 plus odd distributors to fall in this, to get this 1.6 lakh reach for us. And distribution is going to be a continuous journey. While 1.6 is what we are looking at this year, but then that will not stop because India is huge and South is the most penetrated part. So the only way to keep progressing, especially in a category like this, is to keep reaching more outlets.
On that note, it is time for us to head into a short break. But coming up next, Bira 91 is on track to become India's first net zero beer company by 2025. We speak to Ankur Jain, the founder and CEO of the company, on the other side to find out how they plan on achieving this milestone. Stay tuned. Welcome back. You're still with us on Startup Street. Now, Bira 91's Mysuru Brewery becomes India's first net zero brewery in track with the company's mission to zero. Bira 91 aims to become India's first net zero beer company by 2025. The Mysuru Brewery has achieved this milestone through a 360-degree plan to reduce energy use and transition to 100% clean unit. The beer maker has outlined 4 key areas to achieve this mission to zero initiative that was launched last year. We have with us Ankur Jain, the founder and CEO of the company. And also with me is Ritu Singh. Ankur, thank you so much for joining us on the show today. Now, you've partnered with Kirin Holdings last year after they took a minority stake in the company to embark on your sustainable growth journey. Together, you kicked off your net zero project last year. Talk to us about this partnership and the milestones you've reached.
Thank you, Arundathi, for hosting us. Yes, that's correct. When we partnered with Kirin, one of the tenets of this partnership was Kirin's support for strategic projects such as sustainability. Kirin works with a framework called Creating Shared Value, which is essentially a code word for doing things that are win-win-win for customer, companies, and communities. And we thought, as a important leading innovative beer manufacturer, it was our opportunity and also responsibility to sort of power through a net zero future. So we spent the first year studying our own carbon footprint, and last year we announced our project Net Zero with a very ambitious goal of becoming net zero beer company by 2025, which would have been at least 5 or even 10 years ahead of our European peers. And I'm very glad to report that today we are ready to announce our first net zero brewery, and perhaps the country's first net zero brewery. We've actually managed to cut carbon emissions in our Mysuru brewery very, very drastically, and are now net zero for the calendar year 2022.
Hi, Ankur. So like you said, Mysuru Brewery for Bira, that has become perhaps India's first net zero brewery, and of course the first one for the company. This has been done through an 360-degree action plan, so to speak, to reduce energy. Take us through what kind of changes you've made to get there.
Carbon emissions are directly proportional to the amount of energy one uses in making a product or a service. And for us, the first step was always going to be about making our own manufacturing a lot more efficient, ensuring that we are using the minimum amount of energy required by using modern technology, by automating processes, and by recovering any kind of energy that's lost during the process. And that's exactly what we did. But we went one step further. We ensured that whatever energy that we do end up using is sourced by through 100% renewable sources, 100% clean sources, and not generated by burning fossil fuel. And I think a combination of those two factors have led to reduced carbon emissions and net zero outcome for our brewery.
Right, and that's not all. You also plan to become India's first net zero beer company by 2025 through your Mission to Zero initiative. So what are the kind of investments that you have to make, and are you on track to achieve this by the time that you've set?
Absolutely. So we have a very aggressive capital expansion plan that's been put forward over the next 4 years, and that's combined between capacity expansion. We expect to triple our capacity between now and 2025, but also we have a dedicated sustainability budget in terms of capital investments. And interestingly, the payback on our sustainability capex is less than 2 years. So I think from a capital investment standpoint, we're dedicating about $10 million over the next 3 years purely on sustainability.
Well,
and
tripling capacity by 2025, that's some lofty target, but Ankur, let's also talk about your business. So about 11 pints of Bira, 91 are enjoyed every second as you scale up. You've even launched new beers. What more is in the pipeline, and how's demand shaping up?
So on the demand front, this is a very, very exciting summer. It started late because of unseasonal rains in the month of March and early April. But now the intensity of the sun is on full display, and that's great for categories like ours. We're also hoping for the first disruption-free summer in nearly 3 years. And I think, again, from a demand perspective, we are seeing tremendous growth in overall demand for beer and alcoholic beverages. With respect to new product launches, this is a very, very important year for us. Already we've introduced in the first 4 months of this year more than 6 different packaged beer and beer beyond beer categories, where we've introduced seltzers, we've introduced ciders, and 2 new beers were launched literally this week in package in partnership with Delhi Capitals and Mumbai Indians. So this year is a very, very important year for innovation, and in the next 3 to 6 months, it's going to be even more exciting.
Also in FY22, we saw your revenue surge about 66.8%, but your losses also spiked about 58%. So what's the plan to achieve profitability? Where do you hope to end this year?
So our target is to become EBITDA positive this year, and we're well on track to achieve that. We're very hopeful that as demand kicks in, demand recovers for beer, and our scale grows, we will be at an EBITDA break-even situation this fiscal.
Well, Ankur, you recently acquired a pub chain beer cafe to strengthen your play in pubs and tap rooms. Tell us about the acquisition now. Since the last time we spoke, at that time you said you weren't really looking at other acquisitions, but is there something in the pipeline now? Have you changed your mind?
So we don't expect to acquire any new businesses this fiscal. With respect to the beer cafe, I think that partnership is really sort of becoming very, very meaningful. We are today at about 30 pubs and tap rooms, and that's expected to double to about nearly 60 before the end of this fiscal. We're expanding into new geographies. We're deepening our store presence in existing territories, and also ensuring that consumers get a lot more innovation through pubs and restaurants.
Ankur, always a pleasure speaking with you. Thank you very much for your time here on Startup Street. Okay, it's now time, because it's Friday, to take stock of the deals in the startup space. Now, according to Venture Intelligence, this week saw a total of 8 deals which were valued at $87 million. Let's take stock of some of the notable deals that were signed. Safe Security backed $50 million from Source & Capital, 8 Road Ventures and others. Luxury fashion player Purple Style Labs got $14 million from Stark Ventures, while health tech company Tricorg got about $8.5 million from Sony Innovation Fund and Inventus Capital, to name a few. But that's not all. Digital risk protection play Cyma Firm got about $5.5 million, while visual inspection tech startup Switch On got $4.2 million. The startup ecosystem has seen a total of 170 deals worth about $2,300 million this year.
Meanwhile, Elon Musk-owned Twitter has started the much-talked-about Purge verification tick marks for users who have not signed up for its Blue subscription service. This has led to several celebrities, athletes, politicians, industrialists, journalists across the board losing their verification status. The message from the Twitter boss is clear: pay up or lose the blue tick, which is often vaunted as a badge of honor in the Twitterati universe. In his ever-so-cryptic way, Musk tweeted such a great day in so many ways. Aishwarya Anand joins us with more. Aishwarya?
That's right. A quick look at the top Twitter handles. Elon Musk is, of course, at number 1. Former US President Barack Obama has been allocated a grey tick, as his page has been recognized as government or multilateral organization. Justin Bieber, Rihanna, Cristiano Ronaldo and Katy Perry feature in the list as well. Only Rihanna, it looks like, has paid for the subscription. The other icons have lost their verification status. Elon Musk claims to have paid for the blue tick subscriptions of William Shatner, basketball player LeBron James and author Stephen King. All 3 of them had claimed that they would never pay for a subscription. Now back home, many Twitter users also woke up to find that their Twitter blue ticks have disappeared. Prominent industrialists with a significant Twitter following have lost their blue ticks. They include Ratan Tata, Gautam Adani, Uday Kotak and Nandan Nilekani. However, there are corporate captains in the yes to blue tick camp as well. These include the likes of Anand Mahindra, Sajjan Jindal, Harsh Mariwala, Harsh Goenka, Kiran Mazumdar-Shaw and Vijay Shekhar Sharma. That's not all. 74% of the Nifty 50 companies do not have active Twitter verification. There have also been complaints from users about how their blue tick has disappeared despite them paying for the subscription. Hindi film superstar Amitabh Bachchan was one of them. Back to you.
Aishwarya, thank you very much for taking us through that. But on that note, we've run out of time, so it's a wrap on this edition of Startup Street. From Arundathi and me, it's a goodbye, but stay with CNBC-TV18. More news and updates will continue on the other side.